Hello all. So today is third and last session of our ongoing playlist, which is environmental issues in valuation. In session number 1 and 2, we have already covered major part of theory. In today's session, we are going to discuss examples and case studies on valuation of contaminated properties through various approaches: market approach, cost approach, and income approach. We will also start our session with few concepts which are relevant for the calculation of these numericals and case studies. So this is just reiteration of the syllabus, IBBI syllabus, for our reference. So this part we have already covered in session number 1 and 2, and in today's session we will try to focus on examples and case study along with few concepts and theory part which is relevant for the numericals and case study. So let us first try to understand what is the process of valuation of a contaminated property. So these are the broad steps of doing valuation of a contaminated property. So first of all, we have to identify, as a valuer, we have to identify contaminants. What are the contaminants on the property? Then we have to recognize current state of contamination. What is the degree of contamination? Is it in early stage or middle stage or final stage, highly contaminated, low contaminated? Then we have to study regulations and precedents having impact on marketability and value of asset. So if there are any case studies or regulations which proves justifies lower marketability of the value or a reduction in valuation of the property, so that information we have to study. Then we have to compute cost of cleanup technology. So whatever cost to clean that contamination is involved, that we have to calculate. And then we have to calculate property value considering environmental factors, and then we have to prepare the reports. So let us see how these different steps are being applied to calculate various numericals. And let us first try and understand what are the different types of costs which are associated with contamination of a property. So the valuer should understand that contamination is not only lead to remediation cost, but also lead to risks of stigma and less usage. Stigma we discuss in second session and first session also. So various types of costs associated with contamination can be classified into three broad categories. First category is cost effect, second category is use effect, and third category is risk effect. So let us try and understand what are these three type of cost categories and what costs are to be considered into each of these three categories. So first is cost effects. This is the cost of remediation plus additional operating or maintenance cost of the contaminated property. The cost is usually estimated by environmental specialist and not by valuer. So this is the cost of remediation of the contaminated property to remove contamination from the property, and if there is any additional operating cost or maintenance cost post remediation of the contaminated property. So this is the cost effect. These type of cost fall under category of cost effect. Second type of cost associated with the contaminated property are use effects. So even after remediation, the property may not be used to its habu. Highest and best use, habu we discussed in first playlist. Thus this is the reduction in habu value of the property. If any, say for example, if a property non-contaminated or normal property is having a permitted FAR of 4, but because of contamination we are not able to use more than 3 FAR. So the reduction in FAR from permitted FAR of 4 to actual used FAR of 3, that is the reduction in habu. So I'm not able to use that property to the permitted use as per the local bylaws. So the cost associated with that reduction or lowering of usage of the property is called as use effect. Third type of costs associated with the contaminated property falls under category of risk effects. So this is the impact of environmental stigma on property value. Measuring impact of stigma is very difficult. Thus measuring this element usually requires more sophisticated and less direct techniques as below. So analysis of environmental case studies could help us in calculating the risk effects. Then paired sales analysis of potentially impacted properties. We can do comparison of sales, comparison of similar type of potentially impacted properties. Then multiple regression analysis of potentially impacted nearby properties, multiple regression with the help of technique. Market interviews to collect data and information used in other approaches. And income capitalization analysis, that is adjustment of income and yield capitalization rates to reflect environmental risk premiums in an income capitalization analysis. We'll try to understand all these cost and all these factors with the help of case studies and examples, which we are going to discuss in upcoming slides. There are some important terminologies which are relevant for doing valuation of contaminated properties, and we may see these terms. An examiner may ask question based on these terms in the examination. So these are the 4 very important terms which you may find in numerical and IBBI exam, and you will get a hint that this numerical case study is from environmental issues of valuation chapter. So first important terminology which you may come across is unimpaired value. So what is it? It is the market value of the contaminated property considering hypothetical assumption that the property is not contaminated. So this is a valuation market value of a normal property. Second terminology is impaired value. It is the as is value of the contaminated property, that is considering all effects of the contaminated property. So whatever degree or level of contamination is there on the property, so we'll consider that contamination, and we will reduce property value from various type of cost based basically contamination, and that reduced value of the contaminated property as compared to the market value of normal properties is called impaired value. So impaired value is the market value of the contaminated property, and unimpaired value is market value of the normal property without any contamination. Diminution in value of property, this is a terminology, or property value diminution. So these two terminologies may come in the numerical or case study. So it is the reduction in value of property due to its contamination. So once the property gets contaminated, then the value normally gets reduced, and the degree of reduction, the amount of reduction, is called diminution in value, and it is also called property value diminution. It is equal to unimpaired value minus impaired value. So unimpaired value is value of the normal property, and impaired value is value of contamination property. So difference between these two values is equal to property value diminution, and it is sum total of 3 cost effect, use effect, and risk effect. So cost effect is remediation and related cost, use effect is reduction in HABU, and risk effect is environmental stigma, which we discussed in previous slides. And fourth important terminology is remediation cost. It is the cost to clean up the contaminated property plus cost of cleanup of on-site contamination and mitigation of off-site impact due to migrating contaminations. So these are the 3 important methods with the help of which we can do valuation of market approach. So these methods we have already gone through. In case of normal property valuation, there is a slight difference in these methods if we consider the contaminated properties. So we'll try to understand those, what are the different techniques under these 3 approaches. So the impaired value of a contaminated property can rarely be estimated through one of the traditional approaches to value due to data limitation and other factors. Thus necessary adjustment with respect to cost effect, use effect, and risk effect are required to be done in unimpaired value of the property calculated through any of the following 3 approaches. So unimpaired value or market value of a normal property we have already calculated with these 3 approaches. Then we have to make adjustment for these 3 type of effects or costs which are associated with the environmental pollution or contamination of the property. Then we will arrive at the impaired value of the contaminated property. Let us discuss all these three methods step by step with the help of examples. So first approach is market approach. The method is the systematic gathering, recording and analyzing data of similarly affected properties recently sold and comparing sales to the contaminated property being valued. In case data of comparable contaminated property are limited, sales of similar uncontaminated or unimpaired properties can also be used. Thus, process requires joint effort of valuers and environmental experts. So first we will try to gather information about the similar type of contaminated properties. If I have a property which is contaminated, so I'll try to find out data pertaining to if some other properties, quite possible under certain scenarios there is a series of property which have been contaminated, right? So if I'm getting adequate data as a valuer, I'm getting number of sale instances of similarly contaminated properties, I can directly use that with the help of market approach. However, normally I do not get that data. So if I'm not getting comparable data, sales data of comparable contaminated properties, then we'll take data of the uncontaminated properties, sales data of uncontaminated properties, and will make necessary adjustment. Right? So this process requires joint efforts of valuer and the environmental experts. Valuer undertakes valuation of the contaminated property as if it is unimpaired, and environmental engineer assesses the level of contamination of the property to be valued and comparable contaminated properties. So these are the important roles of valuer and environmental expert. So a valuer will do valuation of the property assuming there is no contamination of the property, right? However, then after that market value of the property assuming there is no contamination will come. After that, environmental engineer will assess the degree of the contamination and they jointly will arrive at the various costs associated with removal of the contamination. So if we see the steps from numerical perspective, so there are the four important steps of solving numericals or arriving at valuation, impaired value of the contaminated property with the help of market approach. So first step is identification of contaminated properties. So valuer need to identify as far as possible contaminated properties that are comparable. Then environmental expert reports about presence of contaminant and assesses level of contamination in subject property as vis-a-vis comparable contaminated properties. Then step number 2 is analyze and comparison. Both valuer and environmental engineers need to jointly assess the comparable features of the subject property vis-a-vis comparable contaminated properties. And third step is adjustment of prices of comparable properties. Then we have to do adjustment. Then the difference between the sales of contaminated property and the subject property, the sales instance, are adjusted. The technique to be used is the same as generally used for unimpaired property. So the techniques we used and we studied under our playlist of market approach. So same techniques we will use. Donic model, additional grid model, those methods we will not repeat here. You may refer that playlist for if you're not aware of those methods. So and the last step is determine value of estimate or stigma assessment. So after the comparable sales of impaired property, that is contaminated property, have been carefully analyzed and adjusted, the value estimate can be determined by adjusted sales. So let us try to understand these steps with the help of some examples. So example number 1, determine current value of the property having 40-acre land parcel. Value prior to contamination was 22.5 lakh per acre. Comparable sales of similar size, similarly contaminated property indicates a value of 4.05 lakh per acre. This includes the cost of cleanup, which is already capitalized in the sales price of the comparable sales. Now we have to calculate impaired value and unimpaired value of the property. So here data given, land area is given in the question, which is 40 acre. Land prior to contamination, land rate prior to contamination is given is 22.50 lakh per acre, and land rate of similar contaminant property, that is land rate of property after contamination, is 4.05 lakh per acre. So now we have to calculate unimpaired value and impaired value. So it is very easy. We know unimpaired value is value of the property before contamination. So land area and land rate before contamination, both figures are given. So 40 acre into 22.50 lakh per acre will give us the value of the property before contamination, which is called unimpaired value of the property, and the answer is 900 lakh rupees. And likewise, we will calculate the impaired value, which is equal to land area multiplied by land rate after contamination. Both figures are given in the question. So if we multiply 40 acres with 4.05 lakh rupees per acre, then we will get value of the contaminated property, which is also called impaired value of the property, is equal to 162 lakh. This is answer number 2. Let us see another example of market approach. A market has original unimpaired value of 90 lakh rupees. The comparable sales of the similar contaminated adjacent property is 55.45 lakh. The cost of remediation is found to be 20 lakh rupees. Determine stigma value and stigma value as a percentage of unimpaired value. So here impaired value and unimpaired value and remediation cost, these three figures have been given, and we have to calculate stigma value. So property value in diminution, what is it? Since unimpaired value and impaired value, both figures are given in the question, so that means 90 lakh minus 55.45 lakh. So this is the difference between the unimpaired value and impaired value is equal to property value diminution. It is equal to 34.55 lakh in this present example. Since remediation cost is 20 lakh rupees, so 20 lakh rupees we have to pay for remedying the property. So that means stigma value is equal to value in diminution minus remediation cost. Right? So value in diminution was in previous slide we had seen cost effect, use effect, and risk effect. So remediation cost is cost effect. It is talking about cost effect. Use effect question is silent, so we'll assume nil here. And third is risk effect, which is stigma value. So if we'll reduce this remediation cost or cost effect from total value in diminution, we'll get balance amount is equal to stigma value. Since the question is silent on Habu, so we'll assume zero use effect in this question. So that means stigma value is equal to 14.55 lakh. This is answer number 1. And then stigma value as percentage of unimpaired value. So it is equal to stigma value divided by unimpaired value. Both figures are given. 90 lakh is given and 14.55 lakh we have calculated here. So that is 16.16%. This is answer number 2. Thus, even after completion of remediation work, the original value is not regained to the market. The difference between diminution value and remediation cost is the market imposed penalty, which is also known as stigma. Here stigma is 16.16%, which is quite low. Next approach is cost approach. The cost approach works on principle of estimation of replacement costs. We have already seen in our playlist cost approach of valuation. So it works on the principle of RCN, replacement cost new, or replacement cost by making adjustment for diminution value. So here in this case, while doing valuation of the contaminated properties, we will also consider diminution value. If the property is neither leased out nor falls within orbit of sale in open market, the approach is viable. The approach viable is cost approach. The method needs calculation of direct cost and indirect cost. Let us see what are the different steps. So step number 1, estimating value of the subject property as if it is unimpaired. So first we'll assume the property is non-contaminated, and we'll try to find out the valuation as we have already learned in our previous sessions. Cost approach to valuation, there is a playlist in the description box below. So calculate replacement cost of the property assuming the property is not contaminated. That is step number 1. And after calculating it, then we have to determine direct and indirect cost due to contamination. So primarily direct cost in contamination is cost to cure. It is the total cost to clean up the property to a status of unimpaired level in the market. The valuer, with the help of environmental expert, must determine following 3 components of direct cost. So cost to cure and whether other different type of costs associated with cleanup of the property have already been discussed in second session in our ongoing current series of environmental issues in valuation. So these are the 3 cost component of direct cost: cost of remediation, stigma factor based on provable losses, and specialized cost. 1 mark theory question may come out of this slide. Please note down these factors. So what are probable losses? So remediation cost we have already discussed in previous sessions and in today's session as well, but let us discuss about probable loss and special losses also. So probable losses are the losses on account of known usage of the contaminated property during stages between identification of the contamination and time till the property regained its market value. So thus probable losses include cost of disruption, cost of operation, cost of utility, cost of revenue, cost of liability. All these type of costs have already been discussed in second session. Please, if you have not seen the session, please go through it. So these are the type of specialized cost. It is the additional cost of management of remediation and cleanup. For instance, professional legal fee, insurance expenses during remediation period, cost of discovery of contamination, and future monitoring cost to avoid recurrence of such contamination. And this is the third step, estimating value of contaminated property using step number 1 and 2. So here impaired value is equal to replacement cost, RCN, land plus building, that is unimpaired value, right? Then we have to deduct accrued depreciation if any is there. Then remediation cost we have to reduce. Then stigma cost we have to reduce, and then specialized cost, specialized value, which we discussed in previous slide. Let us try to understand cost approach with the help of an example. The subject land admitting 25 meter into 50 meter is located in the vicinity of a secured landfill. The reproduction cost is rupees 4,200 per square meter. The cost of removing the containment is found to be rupees 505 rupees per square meter. Based on provable losses during the containment, stigma value was worked out to be rupees 302 rupees per square meter. The accrued depreciation may be ignored. Determine replacement cost of the improved property. So here data given in the question is that land area is given, which is equal to 50 multiplied by 25 square meter. So it is equal to 1250 square meter. It's land area. Reproduction cost of contaminated land is given in the question, which is equal to 4200 rupees per square meter. Cost of remediation is given as 505 rupees per square meter, and stigma value is given as rupees 302 rupees per square meter, and accrued depreciation is assumed to be nil. So we have to calculate replacement cost of the improved land. 2 marks theory question can come. So reproduction cost of the contaminated land, or which is also called impaired value, is equal to land area into reproduction cost of the contaminated land, which is equal to 1250 square meter given in the question, and again 4200 rupees per square meter given in the question. Thus it is equal to 52.50. Examiner may ask this thing also, that what is the impaired value of the land. Then answer is 52.50 lakh. Then we have to calculate cost of remediation. Area multiplied by remediation cost, which is again given in the question. So it is equal to 1250 square meter land area multiplied by 505 per square meter is remediation rate of the contaminated property. So it is equal to 1250 multiplied by 505 is equal to 6.31 lakh is the cost of remediation of the contaminated property. Then we have to calculate stigma value, risk factor. So land area is given in the question equal to 1250 square meter, and stigma rate or stigma cost is also given in the question, which is 302 per square meter. So if you multiply 1250 with 302, it is equal to 3.7278 lakhs is the stigma value, stigma cost. Thus replacement cost of improved land is equal to impaired value. Impaired value is property value of the contaminated property plus cost of remediation plus stigma value plus accrued depreciation. So since accrued depreciation is given as nil in the question and these three values have calculated, so it is the 62.59 is the replacement cost new RCN of the improved land. If had the property was not contaminated and it was a new property, then the value of the property of land should have been equal to 62.59 lakhs. Another example, determine the market value if the cost of construction is found diminished on account of discovery of contamination by 35% of its current construction cost. The industrial property worth rupees 20 lakh is located in Raj Industrial Estate, Gujarat, India. Was constructed in 1995. The construction index in 1995 was 1950 and that of current year is 2000. So data given in this question is equal to, it's given as percentage accrued depreciation due to contamination is given in the numerical in the question itself, which is equal to 35%. Original cost of construction in 1995 was 20 lakh rupees and construction index of 1995 was 1450 and construction index of current year given in the question is equal to 2000. So we have to calculate market value of the contaminated property, which is also called impaired value. So replacement cost new of the property if the property is unimpaired, had the property is not is unimpaired or not contaminated, so what should be the RCN of the property? It is equal to COC, cost of construction of 1995 multiplied by cost index of current year divided by cost index of 1995. So this is the indexation formula. We will have a deep session on various type of case studies and examples in our next series, which is on various purpose of valuation. So we'll have discussion on capital gain and also on cost index numericals and case studies. So just have an overview here. Detail we will discuss in subsequent sessions. So RCN of if the property is unimpaired is equal to cost of construction in 1995, which is given as 20 lakh rupees. So multiply by construction cost index construction index of current year, which is 2000 given in the question, and construction index of 1995, which is also given in the question, is equal to 1450. Thus RCN of the property, considering the property is not contaminated, is equal to 27.60 lakh. So accrued depreciation due to contamination is given in the question is equal to 35% of the estimated COC in current year. So 35% of the RCN is on account of accrued depreciation, which is equal to 35% of 27.60 lakh. It is equal to 9.60 lakh. Thus impaired value is equal to RCN minus accrued depreciation. So RCN we have calculated here 27.60 lakh and depreciation we have calculated here. So that means impaired value or value of the contaminated property is equal to 17.94 lakh. Third and last approach technique of doing valuation of contaminated property is with the help of income approach. Income approach is based on principle that contamination of property reduces income generating ability of the property. The income approach also helps in dealing with situation wherein cost to cure exceeds the replacement cost of the property. However, the property still has a value in use or to the owner even if no market exists for contaminated property. So if there is no marketability of the property, if cost to cure increases is more than the replacement cost RCN of the property, then we may not calculate value of property, contaminated property, with the help of previous two methods. So in under these two scenarios we have to take help of income approach if the property is still generating some income. So these are the different steps. Step number 1 is estimating the annual gross income stream by obtaining market rental data. So as like in income approach we discussed in previous session. So similar way we have to calculate first of all annual net operating income from the property. Valuer need to collect market rental data and need to adjust the rental data for cost to cure and loss of utility. Then the valuer can also calculate overall capitalization rate of contaminated property as enter. So capitalization rate is equal to annual net income from the property divided by selling price of the property. So in step number 2 we have to calculate direct certain expenses from gross income. So following expenses related to contamination are allowed to be deducted from the gross income. So first expense which is allowed for reduction is amortized present worth of cost to cure. So this is nothing but capitalized or present value of cost of cure or a series of cost of cure expenses which we may be required to incur for remediation of the property in years to come. Please note that the cost to cure include disruption cost, as there is a partial loss of income due to its partial non-usage. So disruption cost we already discussed in session number 2. This is something the loss of revenue during the remediation process of the property because of non-usage of the property. For example, loss of rental value. So second type of cost which is allowed for deduction, the gross income is equal to the cost of discovery of contamination, including fees paid to the environmental expert. We may be required to pay certain fees to environmental expert to analyze and quantify the exact level of contamination the property is having. Then legal expenses for handling litigation on account of contamination, if there are any litigation which are being being forced on us. So post cleanup monitoring expenses, inflation, etc. So in short, all expenses associated with the removal of contaminant which are actual or reliably anticipated. So here the key terms are actually contamination level has been anticipated or reliably anticipated, likely to happen, must be recorded and deducted. Expenses considered should be based on current cleanup mandates and not mandates which are likely to be invoked only upon sale of property or change in use. So please note down, this is a very important step, and numerical or case study is highly likely to come out of this income approach only. Third step is determination of impaired value using capitalization rate. So valuer may be required to increase the capitalization rate as calculated in step number 1 to reflect the added risk. One such added risk effects on financing against the contaminant property as under the ability of prospective buyer to finance purchase of the contaminant property and the terms of financing the actual cost of cure. So basically in step number 1 we had calculated a capitalization rate, but if we consider the property for which valuation is required to be done by us, the actual subject property, so we there might be certain extra factors which may cause increase in yield or capitalization rate of the property. So we have to little bit analyze that specific property. So one of the factors, like if somebody is planning to buy a contaminant property, so he may not be able to get a easy finance from bank, and even if some bank will give loan to the customer, so bank may charge higher ROI. So accordingly, if in step number 1 we had calculated, for example, 10% capitalization rate, so we may like to, because of that increase in ROI, we may like to adjust that capitalization by 1%, 2%, maybe 5%. So we have to estimate adjusted capitalization rate with this justification. Then impaired value is equal to annual net income from the contaminated property as calculated in step number 2 divided by adjusted capitalization rate, which shall be calculated by adjusting capitalization rate calculated in step number 1. So let us try and understand these techniques with the help of few examples. Kamal had rented his property at 30,000 rupees per annum net of outgoing. The yield up to last year was 10%. Subsequent to a complaint made by his tenant, discovery of the contaminant was made and the yield was found to be 12%. So annual rent of the property 30,000 rupees per annum. There is a net rent, net of outgoing, and then 10% was the yield before identification of the contamination, and 12% was the expected yield after identification of the contamination. And we have to calculate unimpaired value of the property, impaired value of the property, and property value diminution. So data given in the question is net annual rent before and after contamination is same, and given in the question is equal to 30,000 rupees per annum. Expected yield before contamination is given in the question equal to 10%. Expected yield after contamination given in the question equal to 12%. Unimpaired value, impaired value, and value diminution we have to calculate. So unimpaired value of the property is equal to annual net income from the property before contamination divided by expected yield before contamination. This is a perpetual income approach valuation method, and we have already discussed in our playlist income approach to valuation. Please refer that playlist if you are not aware of this formula and derivation of this formula. So this is equal to 30,000 rupees divided by 10%. So that means unimpaired value of the property is 3 lakh rupees. Now impaired value of the property, now after contamination, the net income from the property is likely to be same, which is 30,000 rupees. However, expected yield after contamination is on higher side, which is 12%. So impaired value of the property is equal to 30,000 divided by 12%. It is equal to considering perpetual income from the property, it is equal to 2.50 lakh. So difference between unimpaired value and impaired value is equal to property value diminution. It is equal to 3 lakh minus 2.5 lakh, thus 0.50 lakh is the property value diminution. This is answer number 1, answer number 2 and answer number 3. Another example, the effective gross income of an industrial property contaminated due to chromium fumes is 88.25 lakhs. The annual expenses toward the cost of cure and legal expenses and disruption expenses are 38.78 lakh. From a similar contaminated property, it indicates that 9% rate of return is appropriate. Find value estimate of the property. So data given in the question is here, annual gross income from the contaminated property is given is equal to 88.25 lakh. Cost of cure, legal expenses, disruption costs. So combined figure, all these expenses given as 38.78 lakh, and expected yield from the contaminated property is 9%, and impaired value of contaminated property is nothing but impaired value we have to calculate in the question. Net annual income, since gross income and gross annual expenses have been given. So if we deduct gross and annual expenses from gross annual income, we will get net annual income from the contaminated property. It is equal to 88.25 lakh minus 38.78 lakh. It is equal to 49.47 lakh is the net annual income. Then impaired value is equal to net annual income divided by effective yield, which is given in the question. So 49.47 divided by 9% is equal to 549.67 lakh is the impaired value of the contaminated property. Another example, an industrial property is leased at rent of rupees 220 rupees per square feet and has an annual net operating income of rupees 55 lakh. The said property is found to be partially contaminated. The loss of the useful space will reduce the net operating income to rupees 42.50 lakh during the cleanup operations, which may be completed within 1 year time. The remediation contract is given on turnkey basis to Messrs. Revero Group, who will be paid 5 equal installments of rupees 12.50 lakh every year over 5 years. The yearly payment of installments is proposed to be made from net operating income. The rents are expected to be absolutely market based and market derived discount rate is 12%. Data given in the question is per square feet lease rent is given in the question, which is equal to 20 rupees per square feet. Then annual NOI is given. The property is partially contaminated. It is also in fact is given in the question. Cleanup period is given 1 year. Annual NOI net operating income during the cleanup period is 42.50 lakhs. Remediation cost is given as 12.50 lakhs per annum. Then period of payment of remediation cost is 5 years. So every year for 5 years, up to 5 years, 12.50 lakhs is required to be paid. Remediation cost shall be paid from annual NOI. Post remediation rents are expected to be market based, and discount rate, yield rate, or also called capitalized rate, is equal to 10%. So first year NOI from the property is equal to net operating income is equal to total gross income. NOI during cleanup period, which is given in the question, is equal to 42.50 lakh minus remediation cost. So net income from the property during first year will be equal to, during the cleanup period, is equal to 30 lakh rupees. Then this is cash inflow. So second year to fifth year, every year cleanup will be done. So after cleanup of the property will start earning market rent, which is equal to 55 lakh rupees per annum given in the question, and it would also be required to pay annual remediation cost of 12.50 lakh rupees to Revero Group. Thus annual NOI from the property during second year and between second year and fifth year shall be equal to market rent minus remediation cost, which is equal to 55 lakh minus 12.50 lakh, that is equal to 42.50 lakh per annum will be the cash inflow from the property, net cash inflow or net operating income from the property during second, third, fourth and fifth year, 4 years. And sixth year onward, there will not be any payment of remediation cost. So the property will start earning 55 lakh rupees of annual rent perpetual basis. So then we have to calculate capitalized value of these cash inflows. So impaired value of lessor's interest in the property is equal to present value of first year NOI, which is 30 lakh rupees. Then present value of net operating incomes to be received between second and fifth year, which is 42.50 lakh per annum, and present value of perpetual NOI with effect from 6th year. So 6th year onwards, he will get perpetual NOI of 55 lakh rupees per annum perpetually. So first year present value, NOI present value is equal to capitalization formula we have already gone through in our previous session. Link is given in the description box below. So present value of first year NOI is equal to first year NOI divided by 1 plus R raised to power n. This is a formula for calculating capitalized value or present value of a single cash flow. So 30 lakh rupees divided by 1.1 plus 0.12, it is equal to 26.79 lakh. Likewise, we'll use this formula, same formula, capitalization value formula. So second year cash flow 42.50 lakh divided by 1.12 raised to power 2, 33.80. Third year cash flow, it will remain same, and NOI will remain same. However, we have to discount it for 3 years, so 1 point divided by 1.12 raised to power 3. So it is equal to 30.25 lakh. Fourth year 42, same cash inflow 42.50 lakh divided by 1.12 raised to power 4, because fourth year 4 years discounting has to be done, 27.05. and likewise present value of fifth year cash inflow net operating income will be equal to 24.12 lakh. Now capitalized value of perpetual rent, this after payment of remediation cost during initial 5 years, 6th year onward the company is not required to pay anything to the Revido group, and company will start earning, the property will start generating net operating income of 55 lakh rupees perpetually. So at the end of 6th year, capitalized value of the perpetual rent after 6 year will be equal to annual NOI, which is 55 lakh rupees per annum, divided by 0.12 capitalization rate. So 458.33 lakh will be the capitalized value of the property at the end of 5th year. Now we have to discount this value by dividing it with 1 plus R raised to power n using capitalization formula to arrive at present value of this capitalized value. So present value of perpetual rent to commence with effect from 6th year is equal to capitalized value of perpetual rent divided by 1 plus R raised to power n. This is the capitalization value formula. So it is equal to 458.33 lakh, which is the capitalized value of the perpetual rent, divided by 1 plus 1.12 raised to power 6. Since I will receive that cash inflow after 6 years, so that's why I have divided this 1.12 raised to power 6 to calculate the present value of the capitalized value of the perpetual rent. So that gives me the present value equal to 232.21 lakh. So thus impaired value is equal to present value of cash inflow first year, present value of second, third, fourth, fifth year, and present value of perpetual rent, which I will get after expiry of 5 years, or 6th year onward. It is equal to 232.21 lakh. So impaired value, sum total of all this figure is equal to 374.18 lakh. This is answer to the question. Another example, calculate impaired value and percentage reduction in value from following data. Value of non-contaminated property by comparison approach is 15 lakh. So this is the unimpaired value of the property. Effect of contamination control and management measures, 75,000 rupees. Regular monitoring of site cost, 10,000 rupees. Cleanup cost of on-site contamination, 3.5 lakh rupees. Indemnity insurance for the future, the cost is rupees 10,000 rupees. Control of migration from other sites, 15,000 rupees. Present value of 1 after 20 year, considering capitalization rate of 7.5%. Here directly present value formula is given, so it is equal to 0.235, and anticipated economic life of building is 20 years, and avoidance of origination of contamination of adjacent site cost is 1 lakh rupees. So total cost of remediation is, we had seen in the previous slide, what are the costs to be deducted from the gross rent. So total cost of remediation is equal to cost of contamination control and management, cost of monitoring the site, cleanup cost, insurance cost, cost of controlling migration of contamination, and cost of avoiding contamination of adjacent site. All these costs have been given in the question. We have to simply add up these costs, and the combined value of these costs is 5.60 lakh, but it is required to be incurred after expiry of the economic life, which is the 20 years. So this cost is required to be incurred after 20 years. So we have to calculate present value of this remediation cost by discounting it, by multiplying it with present value of 20 year. It is given in the question. So 5.60 lakh is the total cost of remediation required to be incurred after 20 years. So present value of this 5.6 lakh to be incurred after 20 years is equal to 1.32 lakhs. This figure is given in the question. That means impaired value of the property is equal to unimpaired value given in the question, 15 lakh rupees, and present value of remediation cost, which is we have got here. So this is the impaired value of the property, and answer to question number 1. Next question is percentage reduction value. So since we have got unimpaired value of the property given in the question and the impaired value we have calculated, so unimpaired divided by impaired value minus impaired value divided by unimpaired value. So this is the 8.73 is the reduction in value of the property due to contamination. That's all in today's session. So before I'll tell you what we are going to have in our next playlist or next session, I would request you to please subscribe to the channel and click on bell icon so that you will be immediately notified about the coming sessions. So next series or session or playlist, we are going to start with our 4 marks theory on various purpose of valuation. So we'll try to discuss what are the different purposes of valuation, like bank finance, auction reserve, building insurance, sale, purchase, valuation disputes in court, probate, partition. So a lot of things we'll discuss, and we'll also discuss we'll also have an overview of Indian accounting standards which are relevant for valuation, and Companies Act overview we'll also try to understand valuers function and responsibilities, those things, professional negligence, judgments, etc. And we'll try to cover these theory in 2 sessions, and after that we will have an exclusive session on capital gain methods. We'll do examples on case studies on capital gain methods, and numerical or case study may come out of it, and cost index method we will have 4 session. So thanks for watching today's session. Thank you.